Hello friends, have you heard about a historical event called Tulip Mania? No, let me explain this event to you in this video. Tulip Mania refers to a historic event that occurred in the period of the Dutch Golden Age during the 17th century, when the prices of tulip bulbs soared to extraordinary levels, followed by a dramatic collapse. It is often cited as one of the most famous examples of speculative bubbles in financial history. Let's go through each stage of this event to understand and learn important investing lessons from it. 1. Rise in prices. By the early 17th century, tulip prices began to rise rapidly. This happened because tulips were relatively new to the Netherlands and were considered exotic and unique. The vibrant colors and intricate patterns of certain tulip varieties made them highly desirable. Thus, the limited supply of these rare and coveted bulbs created an aura of exclusivity and scarcity. Prices surged and bulbs became highly sought after as investments. The Dutch Golden Age was a period of economic prosperity in the Netherlands. As the economy flourished, people had more disposable income to spend on luxury items, including tulip bulbs. Tulips became a symbol of wealth and social status. Owning rare and prized tulip varieties demonstrated one's affluence and taste. The desire to display wealth and status drove demand for these high-value bulbs. 2. Introduction of futures contracts. Tulips reproduce slowly, primarily through bulb offsets or bulbs growing from the parent bulb. This slow propagation process limited the supply of specific tulip varieties, increasing their scarcity and driving up prices. This resulted in a unique trading system called wind handle emerged, allowing investors to trade tulip bulbs that were still in the ground. This system laid the foundation for the development of futures contracts, enabling buyers to purchase bulbs at a predetermined price for future delivery. 3. Trading speculation. Speculation in tulips intensified as people began buying bulbs solely with the intention of selling them at a higher price without ever taking physical possession. This speculative trading further drove up prices and created a sense of euphoria among investors. As the prices of tulip bulbs began to rise, people started perceiving them as a profitable investment. 4. Bulb price escalation. The upward momentum and the perception of easy profits attracted more investors, leading to a herd mentality. Fear of missing out, FOMO, drove more people to enter the market, creating a self-reinforcing cycle of rising prices. Tulip Mania gained widespread attention and became a topic of conversation among all levels of society. Stories of quick fortunes made from tulip bulb trading further fueled speculative interest. Speculators, driven by the prospects of making substantial profits, entered the market in droves, driving prices even higher. The prices of tulip bulbs reached extraordinary levels, with some rare varieties commanding exorbitant sums. There are famous accounts of single tulip bulbs being sold for prices equivalent to luxurious houses or large estates. 5. Collapse of the market. In February 1637, the tulip market abruptly crashed. The sequence of the collapse was as below. A. As the popularity of tulip bulb trading grew, more people entered the market seeking to profit from rising prices. The market became saturated with speculators, leading to a decrease in demand relative to the supply of tulip bulbs. This oversaturation contributed to the downward pressure on prices. B. Some investors began to question the rationale behind the skyrocketing prices. Doubts arose about the intrinsic value of tulip bulbs and the sustainability of the market. This shift in sentiment led to increased caution and a growing realization that the market was driven by speculative trading rather than fundamental value. C. The Dutch government eventually stepped in to address the speculative trading practices and the risks they posed to the economy. In February 1637, they issued regulations to nullify outstanding contracts, effectively invalidating futures contracts and halting speculative trading. This regulatory intervention had a destabilizing effect on the market, further contributing to the collapse. D. As doubts about the sustainability of the tulip market grew, panic ensued among investors. Fearful of losing their investments, many speculators rushed to sell their tulip bulb holdings. The sudden influx of supply overwhelmed the dwindling demand, leading to a significant drop in prices. The collapse of Tulip Mania eroded investor confidence in the tulip market and in speculative trading practices more broadly. The realization that tulip bulbs held no intrinsic value shattered the trust and optimism that had fueled the market's rise. This loss of confidence spread rapidly, triggering a contagion effect as more investors rushed to sell their holdings, perpetuating the downward spiral of prices. 6. Financial repercussions. Many investors who had taken on substantial debt to finance their tulip bulb purchases faced severe financial losses. The collapse of the tulip market had a significant impact on the Dutch economy, leading to bankruptcies and economic downturns. Tulip Mania serves as a cautionary tale about the dangers of speculative bubbles and irrational exuberance in financial markets. It highlights how investor sentiment and the perception of value can drive prices to unsustainable levels, ultimately resulting in a market crash and significant financial losses.